I remember when this company came IPO with just gangbusters. Everybody was excited about this company and what it could do. I remember using it, and it was a super easy, a great way to share files and keep things backed up to date, and communicate and share files amongst teams and whatnot. But it's not had the greatest run as of late, and so be interested to see what you think about how the quarter went.
Yeah, you're absolutely right. This was a very much hyped stock for a little while. Part of that is Chamath Palihapitiya, a
There you
very
go.
famous investor. He was very high on Box as a stock, pitched it to the Sohan conference, I believe it's called. And so, yeah, this generated a lot of buzz right out of the IPO gate in 2015, and never really has found its stride. So yesterday it reported earnings for the second quarter, again, of its fiscal 2022. Just make sure we're all on the same page here. The stock was down today. But let's keep it in perspective. It's up 40% year to date and beating the market. So it has been doing very well this year. So let me cut to the chase. If you look at the top line and the bottom line, it was a beat on both. So it beat management guidance on both the bottom and the top, and it beat analyst expectations also on the bottom and the top, and it raised guidance on both as well. So if you're looking at top line revenue, $214.5 million, that was up 12% year over year. Exceeded the high end of guidance by about 2 million. Analysts were expecting about the same. Now, if you look at full year revenue guidance, they were forecasting 853 million on the high end. Now they're forecasting 856 to 860. So raise about 3 to 7 million. Bottom line, this is non-GAAP. And the reason I'm sharing non-GAAP numbers, I don't normally like to share these, but these are the numbers that management gave guidance for, and these are the numbers that analysts have also put out expectations. So they reported non-GAAP earnings per share of 21 cents. That was up better than revenue. That was up 17%. It beat guidance by a lot. Beat guidance by 11 cents per share, beat analyst expectations, and they wound up raising their full year guidance on that as well. Full year, they expect 79 to 81 cents, up about 3 to 5 pennies. What's important about this to me, when you talk about companies that beat expectations, raise guidance, see, management is developing a track record with investors. And over Box's time as a public company, really haven't been all that dependable on the forecasting side, right? So there was a while that they were forecasting $1 billion in annual revenue. And I believe it was by 2018, they said they were going to reach this. And then it kind of got pushed back. No, we're going to reach $1 billion annual run rate. And then it finally got suspended all entirely. They kept not hitting the guidance that they were putting out. For me, I was an early shareholder of Box. After years of underperformance and not hitting guidance, I wound up selling the stock. But what Box is starting to do, and hey, let's be tentatively hopeful, 5 straight quarters of beating their guidance. So it's almost as if they're reestablishing a track record here with investors. And now I'm going to try to share my screen again here. I want to keep some things in context. All right, I think I did it. So if we look at, Trevor was talking about this, RPO, remaining performance obligations. Okay, this is basically the revenue that's under contract, but they haven't recognized yet. You look right here. This is for this quarter. As of this quarter, they have 922 million remaining performance obligations, up 27% year over year. Okay, now that is much better than the 12% revenue growth that they have forecasted. And what this does is it really makes their revenue a little bit more predictable for them, having all that already on the books, right? So it really gives more there's two reasons why you can start to trust management's guidance a little bit more. One, they've hit 5 quarters in a row, and now they have all of this RPO on the books that should give them great visibility. Now, if you look at this slide here, Box is pretty complicated the way that they forecast things going forward. So if you look at this right here, revenue growth plus free cash flow margin. So they're saying that these are a combination of the two. That can be a little bit tricky here, but you can see they have fiscal year 24, so 2.5 years out, or excuse me, 1.5 years out. They're saying 40% revenue plus free cash flow margin. So 14% revenue growth at the midpoint here. If you forecast this out, basically what they're envisioning over the next couple of years for their business, they foresee basically by fiscal 2024, they should be having about 1.1 billion in revenue. And that should translate to about 290 million in free cash flow. So that would be a very much a positive step in the right direction. Now, one final thing, though, that I will mention, it's not so much about generating cash flow, it's how you use cash flow. And so this most recent quarter, they spent 308 million in share buybacks. Part of their guidance seems to assume that they're not retiring all those shares. It wasn't real clear, but I want to show you this chart right here from Y Charts here. This is the outstanding shares from Box over the last 5 years. As you can see, they continue to dilute shareholder value over time. So normalized here, share count is up 26% over the last 5 years. Buying back shares is fine. But if they're not retiring those shares, it's not as good as if, you know what I'm saying? You really want to see them retire the shares to have the shareholder value creation.
Right. Yeah, they may be buying back, but they're allocating to employees more than they're buying back. So that's what you're seeing as a result there.
How do I unshare my screen? Oh, there it is.
Yeah, you get it. It's hard to find.
Good now?
Yep.
Okay. So yeah,
you make an interesting case for Box. It's coming around, and I look at the last 5 quarters. It's right around a 10% average year-over-year growth. So it is exciting to see the RPO growing at a higher number. I don't know, how well the products that this company does. Are they expanding their product line to because I always just thought they were the sort of the store your files in the box, right?
Yeah, and I think this was the big thesis originally with this company, was that they were going to have all this data. So I believe it's something like 80% of the Fortune 500 is a Box customer or something like that. And they have all these files on the cloud. And the idea was they were going to be able to monetize those with more products over time. It is true that they have launched new products over time. It hasn't translated into a ton of incremental revenue. So for example, they have kind of a cybersecurity offering for the data. They also just launched an e-signature thing that's integrated natively into Box. So they do have these other products. If you look at their churn rate in the most recent quarter, it was 5%. So they lost a few customers there, but net retention 106. So they were able to successfully upsell some existing customers to some more products. It's pretty low right now, but it is increasing. So kind of this long held dream of this thesis may actually be starting to play out.